Good day, everyone. This is topic 1 of Module 3, Evaluating a Bank's Returns, Risk, and Overall Performance. Using basic ideas from business finance. So there are two activities of any business. First, we have operating terms. It is buying raw materials and combines them with capital and labor to produce goods and services. It then sells the products at a price that could generate returns. And second, we have financial terms. It is obtaining funds through creditors or owners and spends them on raw materials, labor, and fixed assets. Sales follow, and firm recovers the funds as customers make payments. In any business, the management's first objective is to maximize the value of the owner's investment. Please take note. So how do businesses maximize their value? First, we have the publicly held businesses. So it is a business that registers securities in the stock market and sells them to the public. Most publicly held companies begin as private corporations with only a few shareholders. And second, we have the small businesses. For small businesses, they maximize value by offering quality services and quality products, achieving customer satisfaction, and giving them convenience. They also give discounts and promos as part of their marketing and promotional activities, thereby creating publicity and exposure. Balance sheet. So we have here a sample balance sheet of a business. So we have assets. Under assets, we have cash, accounts receivable, inventory, PPE or property, plant, and equipment net. On the other side, we have the liabilities and equity. So we have the current liabilities, the long-term debt or the non-current liabilities, and the equity side, we have the common stock and retained earnings. So again, always remember that a balance sheet should be balanced, of course. So we have assets equals liabilities plus equity. Income statement. We have here a sample income statement for our discussion. So we have here revenues or sales, less cost of goods sold or COGS. The difference is the gross operating income. We then again less the selling and administrative expenses. We arrive at the net operating income. We deduct the interest. We arrive at the taxable income. And of course, we deduct the taxes which is due for the government. And the bottom line, we arrive at the net income or profit, the very goal of all businesses. Profitability analysis. Based on the figures given in the previous two slides, we arrive at these ratios. So we have gross margin of 25%. Net margin before interest and taxes, we have 10%. Net margin after interest and taxes, we have 5.38%. The asset utilization or asset turnover, we have 2 times. The return on assets, we have 10.56%. The leverage multiplier, we have 2 times. The return on equity, 21.12. So how did we get this? Please refer to chapter 3, page 60. All the formula are presented there for your perusal. Please study and yes. A more in-depth profitability analysis is needed to evaluate the quality of a firm's returns. Ratios calculated must be compared against a same-size firm or the industry, and the higher the risk, the higher the return. An optimal balance between risk and return should maximize the value of the owner's investment, again, which is the management's primary objective. We have here a question. How are businesses similar to a bank? So financial institutions, its raw materials are the funds or the deposits, borrowings, and equity of the bank. Its products sold are the funds packaged under a usable form or what we call the loans. We will be using the sample financial statement of XYZ Bank for our calculations. Here are the details. We also have the income statement of XYZ Bank. We will also use this one for our calculation. Given the details from the previous two slides, the sample income statement and balance sheet, we arrive at this profitability analysis or ratios of XYZ Bank. We have here the interest margin of 5.6%, net margin after tax of 14.7%, asset utilization or asset turnover, we have 9.0%, return on assets, we have 1.32%, the leverage multiplier is 14.3%, and the return on equity of 18.86%. We start with the profitability ratios. First, we have interest margin. It measures the net return on the bank's earning assets. The formula is net interest income over earning assets. Net margin represents how much net income or profit is generated as a percentage of revenue. It illustrates how much of each peso in revenue collected by a bank is translated into profit. Formula is net income over revenues. Asset utilization. It reflects how effectively management has invested in earning assets by calculating the overall yields earned on the assets. So formula is revenues over total assets. Return on assets. It reflects the management's ability to utilize the bank's financial and real resources to generate net income. Formula is net income over total assets. Leverage multiplier. It measures the portion of the bank's assets that are financed by the stockholders' equity. Formula is total assets over total equity. Lastly, for the profitability ratios, we have the ROE or return on equity. It reveals how well managers have done in maximizing shareholders' wealth. It tells how much has been earned on the book value of common shareholders' investment. Formula is net income over total equity. Key return and risk measures for a bank. We present a simplified example of a commercial bank in a hypothetical environment to illustrate further how to measure bank returns and risk and how to evaluate their interrelationships. Assuming the bank obtains funds only through transaction demand deposits, short-term savings and time deposits, long-term savings and time deposits, borrowings from other sources, and equity. Assuming the bank employs the funds obtained only through short-term high-quality debt securities, long-term high-quality debt securities, good quality loans with variable interest rate, medium quality loans with variable interest rate, and good quality loans with fixed interest rate. Please refer to Table 3.4 on page 64 for the hypothesized environment. Check the table, and please do not confuse yourselves because figures and rates are all given. Measuring returns. Questions asked: so how well has the bank performed? Has the bank earned acceptable returns? What risks has it taken to achieve these returns? So these questions can be answered through the profitability ratios presented earlier. So kindly review. Measuring risk. There are a lot of risks that a bank need to calculate and control. So first we have liquidity risk. It shows the relationship of a bank's liquidity needs, permitting deposit outflows and loan increases, versus its actual or potential sources of liquidity from either selling an asset it holds or acquiring additional liabilities. It is also the risk that the bank may be unable to meet short-term financial demands and usually occur during the inability to convert a security or hard asset to cash without a loss of capital and/or income in the process. So formula is short-term securities over total deposits. Next, we have the interest rate risk. It is related to the changes in asset and liability returns and values caused by movements in interest rates. So as shown in the graph, we have here the interest rate from 2002 to 2020. So you could see the fluctuation of the interest. So borrowing rates change daily. Thus, loans with variable interest rate have a huge impact to the returns and the interest rate risk of the bank. It also reflects the risk that the bank is willing to take and can predict the future direction of interest rates. So formula, interest-sensitive assets over interest-sensitive liabilities. When ratio is above 1.0, lower returns if interest rate decreases, higher returns if interest rate increases. Can minimize interest rate risk with an interest sensitivity rate close to 1.0. The third one is the credit risk or default risk. It is defined as the risk that the interest or principal or both on securities and loans will not be paid as promised. So formula is loans over total assets. So a better measure, relative amount of past due loans or loan losses. So higher the risk, the higher the returns. Fourth, we have the capital risk. It indicates how much asset values may decline before the position of its depositors and other creditors is exposed. Potential loss of part or all of an investment. So formula is capital over total assets. Setting objectives for returns and risk. So in setting the ideal return and risk, returns increase by increasing one or more of the primary risk a bank may take. So what degree of total risk should a bank take to increase returns? How much of which type of risk should a bank take? So, what do you think? There are 3 steps to help identify the objectives. First, assess how other similar individual banks and group of banks have made their risk-return decisions. Second, compare a bank's performance measurements with those of similar banks. And third, set a reasonable objective given the historical performance, peer performance, and its environment. Return risk trade-offs. There is usually a difficulty in achieving conflicting goals and the trade-offs between returns and risk taken by most of the banks. Take these calculations for example. So we have the ratio, the target, and you have the scenario 1. Here, scenario 1 and scenario 2 are being compared. So figures are being presented. And here we have scenario 3. Figures are being shown. Assessing the cumulative risk-return trade-off of all positions can provide insight on whether a bank assumes enough risk to achieve its long-term objectives, or if the risk levels are too high with its existing holdings. And this is the end of this chapter. For enrichment, please study chapter 3 of the reference material that I gave. And thank you.